Hello, my real estate friends. This is Kenn Renner, real estate broker in the North Austin area, specifically Liberty Hill, Texas, which is on the north end of the Austin metro. Just giving you an update of what's going on in the market. I'm actually doing this webinar for you to give you a real-time view of what's going on in the real estate market here in Central Texas, as well as in other areas near Austin. And so I wanted to, I'm going to have a lot of great information for you. I'm going to be talking about the impact of the interest rates, inflation. We're going to have a lot of charts, a lot of information that'll be really helpful for you moving forward, how to navigate these waters as as I say in the first slide, times they are changing. So we've had quite a run here in Austin, and those that have purchased properties from me know they've done very well with their investments, and the values of properties going up. But well, as the seasons change, so do the seasons of the market, and so we have to navigate those waters and also see the opportunities within those within those markets, as we've been dealing, obviously, for the last several years with an overheated, very greedy based market. Not greedy, but I'm saying it's been in a high appreciation, people getting in, the old FOMO, fear of missing out. And now that the market has changed because of all the different economic factors, which we'll get into, now the market's starting to shift a little bit towards buyers, but we're still very much in a seller's market here in Texas, and people keep moving here, and people still need places to live. So it's actually as sales have started to slow down and prices have even started to adjust down. The good news is, if you're a landlord, you own real estate, rents are going up, and they'll continue to go up, and I'll show you some reasons why. Now, I'm Kenn Renner. I'm sure you probably have watched some of my videos before. If you haven't, but I've been in the business now. Next year will be my 40th year in real estate. I got my first license in Anchorage, Alaska in 1983 at 19 years old. So, and I've never looked back. We've been doing this for 40 years. I've been through booms and busts in 4 different states. And so I've been through this before. One of the things I really want to make sure that you know in real estate is one of the few places that have a bundle of benefits, even in times where I will show you some charts, even in times of recession and things like that. Real estate usually, unless it's a apocalypse like it was in 2008, it always does well, and it always is a great place to hedge it against inflation. And we're going to get into those details. But I appreciate the nearly 300 people, investors and home buyers that have purchased homes for me in the last 2 years. It's been quite a run. It's been quite a well, I guess I would call it a marathon. In fact, I talked to some of my clients and I say, I feel like I've been a NASCAR auto racer that's gone about 30 laps too long without a pit stop. So fortunately, I was able to take some family vacations for the first time in a couple of years. So here we are in the middle of summer 2022. And I'm ready to get back at it, helping people that may want to sell, take advantage of the appreciated prices, those that may want to buy. There's some great opportunities, and got to know where to throw the dart. In either one of those cases, you need a real estate expert that knows this market, and preferably one whose whole team has gone through adjustments in the market, booms and busts. Right now, we're not forecasting any kind of bust in the Austin market. We're going to see some adjustments down, and we're going to get into that. So we are seeing people take their money, their equity out, and then moving it to other areas nearby Austin, which are much more affordable. So that's with that being said, I appreciate those who have worked with me in the past, and I hope you find this information valuable. All right, so let me go ahead and share my screen. And the funny thing was that this was started off to be a podcast. And then I got with Sandy, my podcast guy, and he goes, no, there's 25 slides on here. This is not a podcast. This is a webinar. But I think that's really important right now, and to gain perspective on what's going on in the market. And number one rule in real estate is, and any investment, is don't panic. And we're seeing a lot of panic going on, and panic actually can be to our favor when we're the buyers or we're the investors looking to capitalize on people that are running in fear, so to speak. So, but anyways, let's go ahead and dive right into some of the cool things that I've come up with here. Lots of information, lots of charts. And let me see if I can get this to roll in there. There we go. Okay, and then we're going to take this over a little bit. I can kind of talk to you as I walk through this. All right. So This is my new Central Texas investment webinar, and this is very up-to-date information. I'm just moving into August of 2022. All right, so boy, times are changing. This city has blown up, and the whole metro has blown up, and I don't need to really go into a whole lot of details. National news over the last several years has just done all the marketing homework for me. I just happen to be at the right place at the right time with the right product, and that's kind of what I teach my agents and other people that really the saying about being lucky is really where opportunity meets preparedness. And I started, working the California market, bringing people out here back in the early 2000s when it was booming here, and people were leaving California. Same thing in 2017. I started going back to California because I saw the change in the market. One thing that's great about real estate is that it is relatively predictable. It goes up and it goes down, it goes up, it goes down. But normally it goes up and down, but always a trajectory over time, as with any good investment, is that it continues to rise. And so let's talk about what's happened recently, the change of the seasons. Really the market has been completely different now than it was a year ago from now, or even 6 months, or even 3 months ago. Okay. And there's going to be good opportunities for those that are thinking like investors, not thinking as speculators. So number one thing we have is a runaway inflation. And we know that it's basically 9 to 10%. And this is yesterday was the day the Feds just raised rates another 3/4 of a point. Inflation is the enemy of the value of property and everything else. So and it erodes the value. Now you can't help but have inflation when you print $5 trillion of stimulus money and pump it into the economy. It was going to happen. It was inevitable. And the rate hikes to slow the economy down weren't done quick enough. Should have been done a long time ago. There's still actually several $100 billion of stimulus money that hasn't been spent by those that were given to it, schools and cities and things like that. So we've got a ton of printed money, which causes inflation, and the rates go up to the Fed being very aggressive at raising the rates. This has happened over history. We're hoping for a soft what is it called, a soft landing, but with all the economic things going on, it may not be a soft landing. So number one, we have to prepare for it. If you own property right now, I'm suggesting, as we are, making sure our properties are optimized, making sure our property managers are in place, making sure we're getting full value rents. Just talked to a client the other day that her property manager, not somebody I recommended, but she just renewed her lease in Pflugerville here in Central Texas for $1,625. You can't even get a 1-bedroom apartment for $1,625. The rent should have been $2,000 a month. So you really have to make sure that you're optimizing your rents, taking care of your properties, being for the long haul. Because if not, you're going to have a harder time, number one, selling, or number two, getting good tenants. So a couple of months ago, the Feds raised the rates. By raising the federal funds rate, they slammed the brakes on the economy, driving interest rates from the low 3s into the low to mid 5s, even beyond. We saw that it was even going up over almost 6% for owner occupied, and it's come back down a little bit. Investor pricing has gone through the roof as well. It's changing all of our pro formas, making it not looking as attractive, just basically because they went to almost 6.5%, 7% on fixed rate mortgages. Now, keep in mind that that's all perspective. I got in the business in 1983. Interest rates came down from 18% to 12%, and now the adjustables were starting at 11%, like 7%. Yeah, it was 7% adjustables, 11% fixed rate. Okay, but people were still buying homes. And we're going to kind of look at that. We're going to look at some of the charts and realize that real estate is still a really good place to park your money, especially in times of volatility. Okay, so the Fed slammed the brakes on the market. So we went from waiting lists at all the builders up here in the Northwest, in fact, all over the Central Texas region, builders basically not selling to investors, waiting lists almost in every subdivision. We had bidding wars, we had silent auctions. Most of that has gone away in literally the last 2 months. Most of it now is, time on market is going up. There's a chance to actually be competitive with your bids, with your offers. You can ask for things that you weren't able to ask. The builders are pretty much done with waiting lists. This is a great opportunity, number one, for first-time home buyers to get back in the market. I'm going to talk about a product here that first-time home buyers, which has got a special heart in mind because that's how I got my start, was helping first-time home buyers. A product that allows them to be cash buyers in this market. So, but yeah, first-time home buyers and those that are moving, relocating here, great time. You got now all of a sudden a very anxious sellers market, still a sellers market, but they're very anxious. So there is negotiating going on. The inventory is low, but it's rising quickly. We actually had up over 200% increase in listings. So we're going to show you the stats here in a second. Builders and sellers, you must pivot now. You could put a house on the market 3-6 months ago, and it didn't matter what it looked like or smelled like, it would sell, and usually in multiple offers. Those days are over. So we got to pivot. You got to listen to your wise counsel, your real estate brokers that know what they're doing, have been through this before. You got to stage the property. You got to go along with the marketing. We do open houses. We even do open houses for rentals. So if you need to sell, you need to price aggressively and be cooperative with your real estate professionals, and deal with somebody who knows the changing markets. Don't deal with somebody we haven't had a market shift in this kind of since 2007, 2008, when that whole, and this is not the same as 2007, 2008. But for those that have never been through a downturn, real estate professionals never been through a downturn, they're in for a learning experience. Okay, so I'm actually going to be helping our industry by helping them understand, helping newer agents understand how to be productive in a changing market, because they are changing. All right, so let's get into stats real quick. And this is interesting. This is Austin MSA, so this is the 5-county area. From last year, still up 20%. Nothing to complain about there. All the properties went up 20%, and the year before it was another 30%. So had some amazing appreciation. Those that bought homes from me are very, very happy that they did. And now, but we went from a 0.7 month supply to a 1.2 month supply. This is May. And we see new listings are up 18%. Active listings are 4170, up 146% for the MSA. Pending sales are down. We don't like to see pending sales down. That increases inventory, and that's going to increase your months of inventory. So let's fast forward to June. Median price is $537. I want to show you something that's interesting. It's the first time this has happened in several years. Is May's $550 price is higher than the previous. The June's it was higher than June's. So in other words, we had a price drop of a few, not much, $15,000 or whatever. But when I get to the city of Austin, it's going to be a little bit different story. So active listings in June. So you saw active listings were up 146% in May. Now we go to June, it's up 217%. So obviously you have a flood of homes on the market, 7,090 homes on the market, whereas we last year, over the last couple of years, we've gotten down to under 700 houses on the market. So new listings are up 19%. People are trying to sell to capitalize on the equity that's still there. And that equity can erode if you need to sell. Time is to sell it now. And if you don't need to sell, then the time is for you to wait and optimize your property. I am a buy and hold strategist. We don't really like selling, but if you were, looking at consolidating your portfolio right now, if you have multiple properties, I would look at the ones that aren't performing so well and consider selling it while the equity is there. Do as 1031 tax deferred exchange, or whatever you may want to do with the money. But it's the equity is there now, but you can see it's starting to evaporate. Now, here's the one that really caught my eye, is the city of Austin in May. Median price, the highest it's ever been, 667,000, which just blows me away. And that was up 18% from a year ago. But we go into June. It was a 1 month supply. Okay, we go into June in the city. We went to 1.8 month supply. It's 615. Difference is 667 to $650,000 drop in median sales price. Closed sales are down 22%. Still very short active days on the market, which is starting to change. They're starting to get longer, especially in different price points. We're going to go over that. There's a lot of information this time. So just sit down, get your popcorn, and go ahead and watch what I'm going over, because it's going to be interesting. I'm very much a stats kind of person. I'm a wannabe novice economist, but when I focus on this particular part of the market, I'm usually right on. And so this is where we're at today. Okay, dollar volume down 16%. We're up to 1.8 months, which is still very. A normal market in a normal real estate cycle is six or 6.5 months of inventory. So we're still in a seller's market, but we're seeing prices drop. And so price, once again, my first slide, price aggressively. If you got to undercut the market. Okay. In other words, if the market's here, people have a tendency to price it at the market. Then Joe has to lower his price because he needs to sell his house. And then Mary goes, well, I guess I better lower it too, because my house now competing, I'm not going to sell. And then Joe says, no, I really need to sell. And then I call it the stair step down. And so don't do the stair step down. Be aggressive with your pricing, because you'll find that you'll probably be, by the time you get done with it, ahead of the game than you would have been if you tried to price it at the market. Okay, we're going to come back to this slide at the very end, because I want to make a point here that this market is still super strong, and even with an adjustment down in prices, it's still going to be a good place, especially to call home, a great place to reload to. But once again, I would probably consider, if you're in the Austin metro, if you need to sell quickly and sell aggressively priced. If you don't need to sell, just wait it out. This is going back to 2012, the last 10 years. Yes, we've had a huge jump, but if you keep that delta line, that line going through here, you would see that it's going to probably adjust back down, probably, and it already has. Probably the median price being, say, on this chart's 500, is probably going to adjust about 15%. In fact, my house in Terra Vista has already dropped about 30, 40,000, but that's because it went up 30 or 40,000 in February. So it's all relative. Long haulers, the people that are invested for the long haul, this doesn't even really affect them. Higher interest rates, shouldn't even worry about. If you're a cash buyer, you've got this great loan locked in, just hold on to it, hold on to the property, you're going to do well. One of the things I want to show you here, and we'll get back into this at the end of the presentation, because this is where we're seeing people are taking their equity up here at the 600,000 or wherever it's at now, and they are 1031 tax deferring, exchanging it, or they're selling their primary residence and taking the profit and moving to markets that are not far from here, 30, 50 minutes, an hour, to other markets, one of it being San Antonio. And if you notice, if you look at the difference between a San Antonio house, the same house is almost 600,000. It's almost 50% of the value, and you can still see we've got a good run up going in San Antonio. Houston's right up next to that, and then Dallas is stuck in between. So we're seeing a lot of people take this right here, sell now, and divide into maybe a couple houses in San Antonio, maybe 3 properties are separated between Temple, Belton. We even have some people looking at College Station, which is another college town nearby. There's still great opportunities, and it's also a great place to park money. Let's say you want to take it out of the stock market and buy an investment property. We're going to get into that. Where else are you going to be able to park your money where it's going to be safe, and continue to grow and have all the benefits? So this is an old chart that I brought out. It only goes through 2018, but it just kind of shows you, goes all the way back to 1999. That we didn't show the spike. Obviously, there's the spike, the hockey stick that happened a couple over the last 2 years, but this is still very solid, even just going from 99 to 2018. Even during the worst crisis, the mortgage apocalypse of 2008 through 2010, look at the median price still stayed the same, around that 175, 80,000, and it didn't really drop. So if you stay in the median price and below, even with an adjustment down, you're still going to do well. I mean, over it just are you for the long haul? Are you looking to try to be a quick turn? This is a market for long, steady growth, and it's proven itself all the way back into the 80s. Okay, all right. So here's some months of inventory. And this interesting chart is. Well, there is nothing in the 70,000, so I don't know where they even come out these numbers. So basically, the affordable housing between 100, that'd be a little condo, between 100 and 300 is still at a half month supply of inventory. You start to jump up into more of the, closer to the medium price, you have to 1 to 2 months. And what we're interesting to see, if you are a luxury seller, you want to be very cognizant of the fact that this is no longer this is now 4 months of available 1 million and up. So we're seeing price reductions in that, and even working with some of our clients as they get closer to their to closing on a home, maybe even renegotiating some of the renegotiating the contract. Builders were renegotiating contracts with us back in the day when their prices were going up. So the buyers are in a little bit better position, that's for sure, than they were. Okay. I got this from Mark Sprague's presentation. Mark Sprague's a friend of mine and an amazing economist with Independence Title. But this is the signs of a softening market. Days on markets increase. We saw that in the charts. The days are going up. Less offers. We definitely know that's happening. Traffic is really slow right now. Even open house people are complaining. I'm on all the realtor Facebook sites, so I know. More incentives are being offered to buyers, and that's actually really good. I mean, we're seeing 10-15% incentives. I mean, that's huge. Great time to be a buyer. It's especially if you've been waiting this market out and you're ready to buy, you can really snap up some good prices. Listings priced lower than the sales. That's what I was talking about. You're going to want to price below the market if you need to sell, and then lower volume of sales. So we are definitely in a softening market. Okay, here's the builder pickle, and here's where the opportunity is going to run. We're going to kind of visit this again at the end of the presentation. Builders are in a pickle, and here's what happened. In 2021, everything was a shortage, including building permits. Lots weren't coming on the market, couldn't get them through the city. So it wasn't even just the lumber and everything else. It was the fact that they couldn't even get lots to build houses on. And there was a big bottleneck at all the metros as far as getting building permits and everything else involved with it. And then the demand was beyond far from anywhere close to normal. Well, so the builders started ramping up about third quarter, fourth quarter of last year to take advantage of what they were seeing would be one of the most awesome summers and try to get caught up. And so they really started pumping out houses, still having the delays. Let's go back there. Sorry. Still having the delays because of whatever supplies. Could be dishwashers. It just, it didn't matter what it was. Windows were a big deal. We're still having problems with windows getting manufactured. So they ramped up all their homes for speculative inventory for the summer months. Okay. And that's exactly what they did. And now these homes are coming online, and, May hits and the Feds just hit the brakes on the economy by driving up the interest rates. A lot of these people that were qualified at 3.5% aren't qualified at 5.5%. A lot of investors are getting a little skittish about closing, especially when they're getting close to 6.5%, 7%. On their interest rate. That's not making the numbers work. So we're coming up with great solutions for that based on financing, because I'm used to own a mortgage company. So I've got some, and during times when you had to be more creative, and that's what we're looking at. We're helping our mortgage companies get more creative. So like I said, no more waitlist bidding, no more blind auctions. They're offering larger commissions too, just to get these things sold, to entice the agents to bring their people there. It's been very humbling. And it's actually been refreshing, because they're now calling us. They wouldn't give us the time of day as investor brokers, and they've been very humbled because they were very, should we say, arrogant the last several years, these builders. And so we always told them, those have been in the market a while, it's going to change, and you better be nice. And so they're getting really nice to us right now. So builders will cut prices and will slow or stop building. And this is an interesting thing I saw in some articles. Very, very much tuned with what the news is out there. A lot of this news that's out there is negative, downer news. The Chicken Little sky is falling. Don't listen to the sky is falling. We have enough fear-based media out there. Turn it off. Get the facts. Get with the experts. Boots on the ground. So builders will cut their prices, which they have been doing, which they don't want to do because for obvious reasons. So they do a couple different ways. Sometimes they'll just cut the price. Sometimes they'll just increase incentives. That way they can keep their sales price up here, but give you the money on the back end, like for closing costs and upgrades and things like that, so that so they don't have to lower those sales prices, because it's not good for the community. It's not good for the people who already bought to watch those prices going down. But so they are in a pickle because they, especially like in you saw that the luxury market is really starting to take a hit. A lot of people had seen their tech stocks drop 30%. These are wealthy people, but they're like, well, dropping payments. Well, the labor and the materials are still in short supply, so the costs are still rising. But now you're in a pickle because the prices are also going to be starting to drop. So the cost of building is continuing to go up, and the buyers are saying we need the prices to come down, and so they will start to cut. Then what they may do is, if they can't make a decent profit, they'll slow the building. In other words, they won't put as many houses on the ground, or they'll even completely stop, where they just can't make a profit. So they're not going to build in that particular area or at all in that area. So, and that's a shame, because we still need more housing. We're still at 3.8 million, according to the National Association of Realtors, are 3.8 million homes short nationwide. Millennials are hitting the market. So we're offering solutions to the builders. Builders are calling us, and they are offering discounts, like under the table discounts. Like, in other words, Ken, if you can make this work, I'll slip you your client an extra $5,000 off of closing costs, whatever it is. And this came from years of building relationships with these on-sites, where they can talk candidly to us, and we can help them solve their problems, which is getting these homes sold. All right. So going back to the whole financing thing, being involved in creative financing. When I got in the business, and also in a mortgage company back in the 80s, we had to get very strategic and had creative solutions to offer our buyers. There's some new creative solutions that have come up that weren't available back then. One of them that's really cool. I met with the director for Homeward.com, which is a company that helps realtors and their clients be cash buyers for a very small, if no fee, where they'll buy the house for you in cash, and then they'll sell it to you as soon as you can get your loan. So cash buyer companies are coming out now. I'm not big on the iBuyers like Open Door, and, well, of course, Zillow blew their whole, almost sank their company, lost $600 million on their attempt at being an iBuyer. There's still some iBuyers out there. Open Door has been aggressive in Austin, and a lot of the listings that we see in Austin are from Open Door, but they require to be able to buy a home at a lower price, which doesn't help the seller, so that they have enough room to fix it up a little bit, put paint on it, lipstick on a pig, as they call it, and then put it back on the market at a profit. That model, I don't know how it's going to work right now, because I had one of my own properties in Open Door, and they came in about 100,000 below what it was worth. But if you're a cash buyer backed by a company with cash, or even though you're financing it after the fact, that's a really good deal. So we're going to have to do a whole presentation on the Homeward product, and you don't have to be a first-time homebuyer. It could be an investor. Just become a cash buyer. We're going to be looking at these builders are doing rate buy downs. And so, in other words, taking some of that incentive money and buying the interest rate back down to where it was. We're seeing right now, one of our companies, Pulte's advertising fixed rates at 4.25. And what it just means is that they're buying that rate down by paying discount points, by paying extra upfront. And so we're also seeing what's called a 2-1 buy down. And that's interesting. So let's say rates are at 5.5. You can do what's called a 2-1 buy down, which is the first year would be 3.5, which would be 2% lower than the current fixed. The second year would be 1% lower, so it'd be 4.5. So it'd be 3.5, 4.5, And then for the remaining of the loan, it's a fixed rate 5.5%. So it's a 2-1 buy down. Those are really cool. There's even what's called a 3-2-1 buy down. I haven't found many companies doing that yet. That's where you buy it down 3 percentage points. You get down to 2.5, 3.5, 4.5, 5.5. So adjustables are starting to come back. I don't see the typical adjustables that I knew about when I started in the 80s, which is your 6-month or 1-year adjusted every year based on the interest rates. I like adjustable rate mortgages. They're not as attractive when rates are going up, but when they're going down, there's no need to refinance, number one. Number two, something that fixed rate loans do not do that adjustables do, which is as the loan balance gets paid off, the payment also goes down because the payment is based on the interest rate and whatever is left on the loan. So if you had a $200,000 loan adjustable at this payment and you put $50,000 from it because you got an inheritance or whatever, your whole payment would drop substantially because it's based on the life of the loan and at the new rate that is adjusted to. Whereas in fixed rate, it just shortens the term. So if you put a lot of money towards a fixed rate loan, it just means you're going to pay it off in a shorter period of time, but it doesn't lower the payment. And in recessionary times, having ability to control your cash flow by having lower payments is gold. So, and then there's the hybrids, which I like a lot because they'd be fixed for 5 years and then go adjustable, or 7 years and then go adjustable. And the reason I say that in the high, and you're going to see this in the charts, in the high appreciating, high interest rate markets where the rates are going like this, if you have it, they don't stay up for very long. They come back down, and we're going to see that throughout history. Great time to be a landlord. Why? Because people that are not buying, they will wait and rent, but they still need a place to live. And so rents are continuing to accelerate up. We're still seeing a shortage of rental houses. We are still in need of more homes available for rent. And those rents will continue to rise as less and less people are about. Some of them people are just priced out of the market. They can't afford the new interest rates, and so they're going to rent. So we're very, very bullish on long-term rental affordable housing. All right, so yeah, just give you a little bit of the facts on Austin, San Antonio. We made the top 10 list. Austin went up, their rents went up 32% last year. Our rents went up 32%. That's amazing. So at $1,500, or let's say $1,500, that would be almost, I'm going to go up to 2,000, right? Kind of that scenario I was talking about, the lady at 1,625, she should be at $2,000 a month. So it's really important that you get with your property manager before 60 days before the lease is up and make sure they don't, make sure they do their diligence on that rental. And that's what we do. We help out with that. And you'll notice down at the bottom, number 10, San Antonio, 23% rental increase from last year. That's a real solid increase in rents, and that's going to continue as people need a place to live and they're moving here. All right, so this is the rent chart, and this is kind of an interesting. We're seeing that the rents in Austin are, of course, skyrocketing, and we're up almost $2,500, $2,300 a month for a single family. And DFW also doing the same thing. And this, once again, this line going up is really good to see. And also look at San Antonio way down here. Now here's the kicker here. So that brings it to be just about $1,800 a month for the median for a single family. But Austin, just 50 miles north, is almost $2,500 a month. I think it is about $2,500 a month. So you're paying substantially more every month for rent. People are now willing to move to an area that they can afford to not only rent, but also they can afford to buy. And so this is a very interesting chart that the price, not only the prices so much lower in San Antonio, but so are the rents, but they're going in the right direction. I don't see Austin's rents dropping anytime soon. I do maybe see them level out as we do have more inventory than we've had in the past. But that right now, especially with the Northwest Tech Corridor, the people that are moving here for Apple and all that, they're driving up those rents, bidding wars on rents still. All right, this is an interesting chart, rent versus mortgage. And this is an indicator too, is that that it's cheaper to rent right now than it is to have a mortgage payment, especially after the latest increase in rents. So the delta, between being a median home buyer and then the rents year over year, that's why people are going to be looking at, well, I'm just going to stay and rent for a while and wait to see what happens with that. And the wait and see thing is a problem because that takes more buyers out of the market. And then take more buyers out of the market, the prices drop a little bit, and that gets people even more scared. Why would I buy now if the prices are continuing to go down? I don't see that as much in Austin as I do in the Bay Area. We have been watching what's going on in the Bay Area, and they're in for an awakening. So if you're in the Bay Area and want to relocate or sell one of your rental properties in 1031 to a safe haven, I'm your guy. All right, so the near-term opportunities. In every potential crisis, there's always opportunities. And here's what I'm saying is that I think that there's going to be in the next 6 to 12 months coming into third and fourth quarter of this year, especially third and fourth quarter of this year, because of the overbuilding that is not going to be overbuilt for long, because they're going to adjust how many homes are putting on the ground. Not just with builders, but with sellers, including my sellers. Some of my people I've sold houses 20 years ago come back to me and want to sell. Those ones are usually tenant occupied. And so it's nice to be able to buy a property that already has a tenant sitting in place and ready to go, paying the rent, no downtime, no vacancy. We are also seeing great opportunities with the builders as they're just giving these properties away. They just got to get the inventory off the market. So as the supply continues to grow in the builder shadow inventory, is what I call it, been sitting on the market, waiting to hit the market. That shadow inventory is hitting now. And especially if fiscal year ends, D.R. Horton's fiscal year end is September 30th. Lennar's is November 31st or November 30th. And other builders, most of them are on December 31st. So they'll definitely during those quarter and fiscal year ends, those are some great opportunities to get some deep discounts. And we're also talking about putting together bulk buyers where we go in and snap up a bunch of them all at once. And so we're going to ask a little bit of questions here. And as we go into some charts here is where I was talking to Richard Advani. He's a loan officer with Supreme Lending and does most of my mortgages and most of our clients' mortgages. He works in markets all over the United States, Florida, Louisiana, Midwest, so just all over Cincinnati. I mean, all over. And so I asked him, where's a great place to, besides Austin and the Central Texas? He goes, you're pretty much it. They're all pretty much doing the same thing. So I'm still like I'm grateful to be here in Austin where things are still doing great. And he's so. We said, where can you put your money? Cash? Well, if inflation is going at 9-10%, which real rate is more like 20% because it's lagging behind. But if it was 10%, it means if you have $1 million in the bank cash today, and if it's 10% inflation by next year at this time, you'll have 900,000. Just that's its buying power. So you're sitting cash in the bank is watching it drop. Now, I am also an advocate of having great cash reserves because that's opportunity money. So, but if you're just parking it, cash is not a place to invest. Stocks, I'm going to show you some charts on that. That's kind of scary. It's especially for those that have experienced what's happened since the beginning of the year, 30% drop in, the high tech stocks, NASDAQ's is being hammered. It's also putting pretty much a bummer on the party here for people wanting to use their stocks to invest in real estate because it's like, well, it just dropped 30%. You forget that it went up 30% in the last year and a half too. So it's like, did you really lose money or, you don't really lose it. The only way you really capitalize is if you sell out and cash in. Bonds, 3%, 2.5%. I don't know if that's really, inflation's going to eat that up as well. Commodities, gold and silver, maybe, but you don't actually own the gold. You own a paper note that says they'll give you the gold. It's kind of like it's a certificate. It's still paper. Real estate, yes, real estate's still a great place. But you look at this list, where else are you going to put your money and reserve it? And even if it's putting in real estate just to preserve it and beat inflation, our property values have gone up, consistently for 40 years, about 5.5 to 6%, taking booms and busts into account. And when you only own a quarter of the property and it goes up 6 or 7% per year, you're way ahead of inflation. All right. So affordable housing, and that's what we focus on. All right. So it's a key hedge against inflation. If you think about it, little houses are a collection of commodities. So it's the metal in the doors, the copper in the walls, the drywall, all that lumber. It's all a collection of commodities. And so that's why real estate does well in inflationary periods and does well even in recessionary periods. And oil is everything. So now the oil prices have gone through the roof. Everything involved in building a house has oil involved in it. I mean, even if there's no oil in it, the truck that drove it here had oil in it, had gas in it. So, I mean, the paint's oil-based, the paint's everything has something to do with oil. So that's going to have continued to affect the price of all the commodities in the house, driving the commodities altogether up in value. Now there's going to be some adjustments or some discounts and some wholesale deals going on, and that's what we want to capture. But the supply chain issues still continue to drive up costs. So you got oil driving up costs for these builders. You got supply chain issues driving up cost and labor issues. So over the long term, real estate is always going to be a great place to hedge against inflation. All right. So one of the things, we go back to the basics. What does real estate offer? It's basically income. Someone else pays off the mortgage, and whatever's left over is called positive cash flow. I love it that somebody else is paying off the mortgage, and that means they're paying off that balance as it's going down, and you don't have to pay out of pocket. And so depreciation, tax benefits are huge, and we can spend a whole webinar presentation on that. Equity and appreciation, that's icing on the cake. It's been quite a dessert for us here in Austin the last couple of years, but really equity and appreciations for the long term. And leverage is another great. You can borrow a certain percentage of, a majority of the property is borrowed money, other people's money. And so the other thing is it's predictable. Real estate is predictable. We're going to go into some of the charts. It goes in very predictable manners. Appreciation, boom, bust, wherever you have it. And then estate disposition, which is your stepped up basis, which is amazing too, because that means that all the properties that you own, let's say 20 years, you go to the pearly gates and you bequeath all that to your kids, they will not pay the taxes that you would have paid on it if you sold it before you passed. So we're really appreciative that they didn't get rid of that during the last tax law adjustment. But so that is the bundle, and this is an interesting chart too. And so going all the way back to the 60s, you can see the dark lines of the recessions, and then you can also see housing prices. And the only time it ever really dropped was during the Great Recession, which was caused by real estate. All these other recessions were not caused by the real estate. So barring one of these real estate created crashes, we're seeing that out of the last 1, 2, 3, 4, 5, 6, 7, 8, 9, say the last 9 recessions, only one was caused by real estate. Or in other words, the rest of it did well. This is pointed out to me by Richard. He had this slide, and I said, that is a very interesting concept that in recessions, real estate does well, except for the apocalypse of 2008. So that's not going to happen this go around. First of all, everybody has equity, lots of it. We have 20% appreciation nationwide. Have $10 trillion in equity in housing right now. And people have to qualify for their mortgages. That was the big difference that caused that boom and bust back in the early 2000s. Fake money. I mean, fake people, fake borrowers. And I mean, it was no income, no job. Those kinds of loans don't happen right now. So very interesting chart to not be afraid of real estate during recessions. Okay, mortgage rates. I point this out too, because we got people that are saying, well, I don't know, I'm going to pay 6.5% on an investment property mortgage. I mean, that numbers don't make sense. But if I'm showing this to you, that's why those lower interest rate hybrid mortgages, the adjustables, maybe for 5 or 7 year fixed, would maybe a really good place to be, because if rates they've gone up, you always have a chance to refinance. And so if you notice that mortgage rates back in the early 80s, 40 years ago, we had some major recession, and there was a huge aggressive move by the Fed to drive rates all the way to 18% to stop the runaway inflation that was going on back then. This is not probable. It's possible, but once again, the rates didn't stay high for that long, and they compared to where they were, and they continued to drop. And then we had a recession in the 90s, short, that was really kind of due a little bit more from the aerospace industry. And then the rates continued to drop. Then we had our .com bust recession and early 2000s, and then continued to drop. And then we had our crisis, which if you notice, it was not even 2 years of recession, we saw the rates drop again, but we are actually back. This didn't go to where the rates are right now. We're back to about where it was in 2008, which is right about the end of the last, so we're about 5.5%. And this chart didn't quite get there, but we're right about here. So, but the good news is that mortgage rates don't stay up for long. So even if you have to get a shorter term loan, or an adjustable, don't be afraid of that. We have to continue to be on the course of continuing to build portfolio, especially when you can get deep discounts and concessions. It's a kind of an interesting thing what happens to stock markets during the before and during recessions. And this is a little scary for those that are heavily vested in the stock markets, that it almost inevitably your stocks are going to go down during a recession. So what do? You hopefully you pull it out of the stock market, put it in somewhere it's a little more stable, like affordable housing and affordable popular areas to live. So S&P going back to 1959. I mean, this proves that over the long haul, any really good investment, whether it's stocks, bonds, or real estate, over time it's going to do well. You don't want to buy the peaks and sell at the troughs. Okay, so if you go back though in 1997, then what I don't like about this chart is that if you were thinking about retiring in 2000, and then all of a sudden the stocks dropped, which they did between 2000 and 2003, it would take all the way to 2008 to get back to where you were in 2000. You could have lost, what, I don't know, almost half of your retirement if it was all in stocks. Oh, it built back up, but then look what happened again. It dropped again in 2009, and it took all the way until 2013 to get back to where it was in 2000. So you don't want to get caught in one of these, especially if you're in a position. If you're in a long-term hold and you're in it for the 20, 30 years, you're going to do fine, just like as you are with real estate. But I wouldn't want to be caught in any, and this is kind of disturbing here. Our great run up. Congratulations, everybody, for taking advantage of the market. Our little bit of a drop during the pandemic onset, and this is when I should have bought in. I tell people, yeah, if you want to know when the market's going to stock market's going to drop, I'll let you know, because it's when I get in, that's when it drops. So I've kind of stayed out of stocks. I know everybody else has done well, and I've done well because of other people's stocks, because they turned it into real estate. Just food for thought. Interesting charts. Just beware. These things continue to go. Things go up, things go down, things go up, but over the long haul, they do well. All right, NASDAQ, sad story. Well, it's sad depending on if you're in the NASDAQ stock market, down about 30% from the beginning of the year. But then again, it's not much different than it was in 2020. So still over long haul, it's going to do great. But I know it hurts in the short term seeing that those stock portfolios drop. Okay, so back to the chart I started with, which is we have a very strong market. Once again, you can sell a house for almost 600,000 in Austin, hopefully before it drops any further, and 1031 it into 2 houses in San Antonio for 300,000, doubling your value of the properties that you own. You could do a 1031 exchange. It'd be deferred, and you could pay cash for one. That's what you see a lot of people are doing. They're paying they're taking equity, paying cash for one, and then they're financing the second one. So it might not be a good, bad opportunity, bad idea if you were considering liquidating in this still higher appreciated market before it drops. You saw what happened in May. May's median price went from 660 to 615, and we don't want to ride that down. So if you need to sell, need to get your equity out, or just want to, give me a call and we'll get started right away. There's, obviously a lot of these people have sold homes to over the years. These homes are going to need gentrification. We have our crews all ready to go to get the carpet done, the paint done, get it on the market, and get it sold before there's any more loss of equity. Okay. So, and 1031 into great areas. We love San Antonio, New Braunfels, Temple Belton, even looking at some of the Colleen properties. Also expanding into some other areas close by, which is Bryan College Station, where Texas A&M University is. So we're finding the pockets and we're still running with them. Okay. All right. So opportunities, builder inventory, they're getting desperate, which is great opportunity for buyers. Investors are liquidating. So like I said, some of my clients are taking their profit and they're ready to sell. Not just my clients. You're seeing a lot of investor properties hitting the market. Expatriates, I call it, from Austin. You're moving to affordability. I have a client that's sold his townhome in Avery Ranch, and I was building a beautiful house down in New Braunfels. And so he's still in a beautiful area, just 45 minutes south of Austin, but he's paying less for a custom home than he sold a townhome for in Austin. 1031 exchanges, still a great place to move your money to in an exchange. It's our market, especially in our submarkets, is very stable right now. Wholesale cash purchases. Once again, we've got the cash buyer program. I can turn any buyer into a cash buyer, which is awesome. That puts you in great negotiating position. And bulk purchases, we're talking about that, is a lot of these builders have all of a sudden a dozen houses in the same neighborhood that are need to sell. They're sitting empty. They're just sitting there, called standing inventory. And oftentimes we're looking at, putting a group of people together and picking up those deals at wholesale prices. And then syndications, once again, is basically doing the same things, putting together a partnership to be able to buy multiple properties at once. So there are opportunities when they are changing. That's sometimes we make some of our best decisions when other people are panicking, and we come in cool and collected with a cash offer, and everybody's happy. They get out of their fear because they've got the property sold. We get it at a nice discount, and move on with life. So that's my presentation for today. I hope it's been helpful. I did want to give some really good stats, also give you some comfort and understand that the sky is not falling, that we're here for you. We also like to talk to you about your particular property. If you have a couple of properties with us, we'd like to visit with you about your property management experience. We'd like to visit with you about how your insurance is doing. This is time to optimize your properties. Make sure we don't do too much deferred maintenance. The ones that rent the quickest are the ones that look and smell the best. And so we want to make sure that when time comes to renew or to release the property, that it could be a good time also to fix the property up, make it look really good, because those are the ones that are moving. And then keep in touch with me, and I'm available. But people always say, "Oh my gosh, you do all these things. You're on, HGTV, and you're doing writing the books and doing the articles." Look, I'm never too busy to help a client or one of their referrals out. And so please reach out to me, 512-423-5626, or you can use my call scheduler. That's great. You can pick your time on my calendar. It's callkenn.com, callkenn.com. And then, of course, keep an eye on my podcast, which is, we'll be doing another one tomorrow, kind of a mini version of this presentation here, but also always entertaining and full of wisdom that we hope would help you in your real estate investments now and in the future. All right, it's Kenn Renner, real estate broker and real estate expert in the Austin, Texas area, Liberty Hill to be exact. Give me a call and we'll get going. Have a great day. Appreciate it. See you at the top.